Welcome back to Talk Tickers. Today we are looking at a ticker that, it woke up, chose violence, and left the entire market just scratching its head.
Hey, that's one way to put it.
We are talking about 8x8, ticker symbol EGHT. And I have to be honest, if you were watching the tape on Wednesday morning, you probably thought your data feed was broken.
It was definitely a check your glasses moment. I mean, you had a stock that closed the after-hours session down about, 3.5%?
Down.
Only to open the next morning and absolutely rip, finishing the day up nearly 47%.
47%. In a single session. That is not a typo. We saw a move from the $1.60 range all the way up to $2.44.
Yeah.
And the volume was just massive.
Over 26 million shares traded.
So the mission for this deep dive is simple. What on earth happened? Was this just a massive short squeeze, or did the fundamentals actually, change overnight?
It's a bit of both, but I'd argue it's mostly the latter. Look, historically, 8x8 has been viewed as this legacy player in the UCaaS space.
Unified Communications as a Service.
Right. Basically, the smaller, struggling cousin of Zoom or RingCentral. But if you really dig into this Q3 Fiscal 26 report, the thesis has completely shifted. The market suddenly realized this company isn't shrinking anymore.
Okay.
It's successfully pivoting from a seat-based phone company to a usage-based AI platform.
That is a very bold claim. I mean, AI platform is a phrase I hear about 10 times a day, usually from companies trying to distract us from some pretty bad numbers.
And I'm usually the first to call that out.
Yeah.
But we'll get into the data.
Okay, so let's unpack this. We need to look at the financials, this whole pivot to usage, the reality of their AI deployment, and of course, cleaning up that messy acquisition history.
The Fuse era is over.
The Fuse era is over. And stick around, because at the end, we have a not financial advice segment where we pitch a trade idea that is, it's creative.
Creative is a good word for it.
But first, hit us with the headline numbers. Why did the algos go so crazy?
Well, the headline beat was solid, but it was really the guidance that lit the fuse. First, let's just talk profitability. Non-GAAP EPS came in at 12 cents. The street was expecting 9.
A 3-cent beat. Now, I know 3 cents doesn't sound like a lot in the grand scheme of things.
It doesn't. But when you're trading at these tiny multiples, a 33% beat on earnings per share is massive. It tells the market the operational efficiency is real. They're squeezing more profit out of every dollar than anyone expected.
Okay, what about the top line? Because usually in these turnaround stories, you see them slash costs to boost earnings, but the revenue is still just falling off a cliff.
And that's the key difference here. That's why this was so big. Revenue came in at $185.1 million, beating estimates of roughly $179 million.
Okay.
And that represents 3.4% year-over-year growth.
All right, I have to play the skeptic here for a second. 3.4% growth. That's not exactly hypergrowth. I mean, that's barely keeping up with inflation. Why does a 3% growth rate trigger a 47% stock rally?
It's all about context. This is a company that investors thought was a melting ice cube. The whole narrative was that revenue was going to zero, or at least shrinking permanently.
Right. Distress.
Exactly. So returning to top-line growth for the third consecutive quarter just changes the narrative from distress to turnaround. You don't need 20% growth when you're priced for bankruptcy. You just need some growth to prove you aren't dying.
Fair point. If the market prices you for the grave and you show up with a pulse, the stock goes up. And the cash flow looked healthy, too.
Very healthy. Operating cash flow was $20.7 million. And critically, management raised their full-year guidance across the board. They lifted the revenue outlook to a range of $729 to $734 million and EPS to 36 or 37 cents.
So they basically stood up and told the market, we are earning more money than you thought, and we're going to keep doing it.
That's the message.
Okay, so beat and raise. That explains maybe a 10-15% pop. But 47, that tells me something deeper is happening in the engine room. Reading through the transcript, there's one metric that just jumped off the page for me.
I think I know which one.
The usage-based revenue.
That is the aha moment right there. Usage-based offerings grew approximately 60% year over year.
60%. Okay, for the listener who isn't a cloud software engineer, break this down for us. What is usage versus the normal business model 8x8 is known for?
The old model, the one everyone knows, is SaaS, software as a service. You sell a seat to a call center agent. You charge, say, $50 a month, whether they make one call or 1,000 calls. It's predictable. It's flat.
Deep, boring.
Exactly. But the new model is all about consumption. It's a hybrid approach. The industry is moving toward paying for what you actually use API calls, AI processing, message volume.
Kind of like my electric bill.
Perfect analogy. You pay for the kilowatts you use, not just a flat fee for having the wire connected to your house. 8x8 is seeing massive traction here because customers love the flexibility. They don't want to commit to 500 seats if they might only need 300 next month.
But here's where it gets really interesting and honestly a little counterintuitive. Because of this shift to usage, their gross margins actually went down. And usually Wall Street hates seeing margins compress.
That's right. Gross margins ticked down sequentially to 64.8%. And that's because usage-based revenue just has lower structural margins than pure software. There are often carrier fees, telecom costs, compute costs involved.
So on the surface, that looks bad.
It does. If you just looked at a spreadsheet, you'd think, oh, that's a negative.
So walk me through the logic. Why did the stock rip if the gross margin is getting worse?
Because of the operating margin. This is the magic trick management pulled off. While gross margins dipped a bit, operating margins expanded to 11.7%. They smashed their own guidance of 9 to 10%.
Translate that for us. How do you have lower gross margin but higher operating profit?
Efficiency and volume. They are trading percentage points for absolute dollars. They're saying, okay, we make a slightly smaller profit percentage on each dollar of revenue because of the usage fees, but we are driving so much more volume and we've cut our overhead expenses so effectively that the actual pile of cash at the end of the day is bigger.
It's a volume play. They're willing to take a slightly smaller slice of a much, much bigger pie.
Precisely. And in this market environment, cash dollars matter more than percentage metrics.
Speaking of volume, we have to talk about AI because every company on earth puts AI in their earnings release title right now. It's practically required by law if you want anyone to read it.
It really is.
But was there anything real here? Or is this just AI washing to pump the stock?
I'm usually the biggest skeptic on this, but the adoption stats here are pretty undeniable. Voice AI interactions on their platform increased more than 200% year over year.
200%. That's exponential growth.
It is. And contracts for their intelligent customer assistant, which is essentially their AI bot, increased 70% year over year. Management explicitly said that voice AI now represents the vast majority of all AI interactions on the platform.
This connects back to something the CEO, Sam Wilson, said. He mentioned that voice is becoming the primary interface for AI. We aren't just typing into chatbots anymore, we're talking to them.
Exactly. And he gave some very specific micro use cases that ground this in reality. It's not just AI will fix everything, it's specific problems. For example, they have a healthcare system using their AI to book appointments 247. It replaced the work of 4 full-time agents.
Now, wait a minute. Pause right there. If I'm an investor, I hear replace 4 agents and I think, uh-oh.
Right.
Doesn't 8x8 get paid per agency? Did they just help the customer fire the very people that generate 8x8's revenue?
And that is the classic cannibalization fear, the fear that your new product eats your old one. But this is why the pivot to usage revenue is so brilliant.
Explain that.
So those 4 agents might be gone or, moved to different higher value roles, but the volume of calls didn't go away. The AI is now answering those calls. And because 8x8 charges for the AI usage in the compute, they are still capturing that revenue.
So they're hedging their own business model.
Exactly. If a human answers, 8x8 gets paid for the seat. If a bot answers, 8x8 gets paid for the usage. They are agnostic to who or what answers the call as long as the call happens on their network.
That's actually really smart. It future-proofs them against the death of the call center agent.
And they are using this internally too, this customer zero concept. They are using their own AI to map customer journeys and tailor solutions. It's making their sales process more efficient, which helps explain why their OpEx is down while revenue is up. They're proving the tech works by running their own company on it.
Okay, so the growth engine is revving up with this AI usage. But we have to talk about the anchor that's been dragging this ship down for years, and that is Fuse.
Ah, yes. The Fuse acquisition. This is a major deal from back in 2022, and honestly, it's been a headache for them.
A huge headache.
Integrating a legacy platform is never easy, and it always takes longer and costs more than anyone expects.
But they rang the bell on this call. It's done.
It is officially done. As of December 31st, 2025, the migration of Fuse customers is complete. The legacy platform is dead.
Why is this such a big deal for the stock price? Is it just about cost savings?
It's an efficiency unlock. For the last 3 years, they've had to maintain 2 separate platforms, 2 separate support teams, 2 separate engineering stacks. It's like trying to fly 2 different airplanes at the same time.
Right.
Now, they can focus 100% of their energy, their R&D, their support on one platform. It simplifies everything.
But there was some bad news buried in here, right? Not every Fuse customer decided to stick around.
Correct. There is a revenue headwind of about $4.5 million in Q4 because some Fuse customers chose not to upgrade. They just left. And that drag will continue into the first half of fiscal 27.
So why did the stock rally if they just admitted they lost customers?
Because investors hate uncertainty more than they hate bad news. Now it's a known quantity. The uncertainty discount is gone. Investors now know it's a $4.5 million hit, it's finite, and it ends in fiscal year 27. They can just model it.
And when you combine that with the debt reduction, they've paid down over $224 million in principal since 2022. It just feels like the bankruptcy risk is basically off the table.
That's exactly what a re-rating looks like. You go from a distressed asset multiple to a stable cash-flowing software multiple, and the gap between those two numbers is, well, apparently it's 47%.
Let's talk about the competitive landscape, because usually when we talk about 8x8, we're comparing them to the giant Zoom and Ring Central, and usually the narrative is that 8x8 gets crushed by the big guys.
Off it is, yeah.
But they highlighted some specific wins against those guys this quarter.
They did. And the reasons why they won are fascinating. Take the regional healthcare system when 850 employees. They beat Zoom and Ring Central. Why? Because 8x8 sent a team on site.
That is so old school. I love it. In a world of digital sales and automated demos, they won because they physically showed up at the hospital.
It shows that in complex industries like healthcare, the partnership still matters. They weren't just selling software. They were selling a solution to a specific workflow problem. They also mentioned a national early education provider with 43,000 employees. They won that one because they were flexible with the OpEx modeling. They aligned with the finance department, not just the IT department.
This validates their platform strategy too, doesn't it? They noted that customers with 3 or more products generate 3 times the revenue of those with just 2.
Right. It's the classic land and expand model. You get in with the phone system, you add the contact center, then you layer on the AI usage, and suddenly that customer is incredibly sticky. You're not going to switch to Zoom just to save 5% if your entire AI workflow and patient booking system is built on 8x8.
The switching costs just become too high.
Exactly.
So bringing this all back to the investor context, we saw this 47% rip. Is this sustainable, or was this just a one-day sugar rush?
Well, you have to look at the broader market. Small cap software has been incredibly weak lately, so investors have been desperate for profitable growth. 8x8 just showed they can return to top-line growth for the third quarter while generating cash.
And that's the magic combination right now.
That's it. So the market is re-rating the stock.
It feels like they're finally moving out of the penalty box.
They are. The valuation logic is shifting. They're no longer being priced as a dying legacy telecom. They're being priced as a stable, cash-flowing AI hybrid company. The catalysts ahead are clear. Can they deliver on this raised guidance in Q4? And can they prove that the Fuse churn really does end in FY27? If they hit those marks, this rally might have legs.
Okay, so that's the rational analysis. That's the Talk Ticker's official breakdown. But now it's time to take off the tie, loosen the collar, and get into the segment everyone is waiting for.
Oh, no. I get nervous every time you use that tone of voice.
You should. It's time for This Is Not Financial Advice.
Disclaimer time. We are not financial advisors. This is for entertainment purposes only. Do not trade based on what we're about to say. We are just 2 voices on the internet speculating on a Wednesday.
Exactly. So here's the pitch. I call this trade the Talk Dirty to Me Voice AI Gamma Squeeze.
Talk dirty to me. I'm almost afraid to ask where you're going with this.
Stick with me. The CEO said it himself. Voice is the interface of choice. We are moving into a world where we don't type to AI, we talk to it. Voice data is the new oil. And who owns the pipes?
8x8. They own the proprietary voice IP and the CPAS usage rails.
Exactly.
Okay, I follow the logic. Voice data is heavy. It's hard to process. If you own the processing layer, you win.
You win. Right now, the market still prices 8x8 like a boring old phone company. But the data shows they are becoming a voice data processing company. Usage is up 60%. AI interactions are up 200%. This is exponential growth happening under the hood of a boring stock.
So what's the trade?
The trade is this. You go long, slightly out of the money leaps long-term equity anticipation securities. You're getting on volatility and time. At the same time, you sell puts on the competitors who are stuck in the old seat-based pricing models.
You're playing the divergence.
Exactly. You're betting on a decoupling. You think 8x8 stops trading like a sauce stock and starts trading like a consumption utility.
Yes.
think about it. If that usage growth goes from 60% to 100%, because everyone starts talking to their AI agents, the volume just explodes. This stock has a low float. It has high short interest because everyone thought it was going bankrupt. If that volume spike hits, you get a gamma squeeze that makes this 47% move look like a warm-up act.
It's aggressive. But I will say, the leverage on that usage model is real. If they don't have to add a ton of infrastructure to handle that extra AI volume, that profit drops straight to the bottom line. You could see earnings double while revenue only goes up 20%.
Exactly. It's an earnings leverage play disguised as a penny stock. You are buying the rails of the voice AI revolution for the price of a latte.
It is wildly speculative. I mean, it assumes their technology holds up and that the big guys, Microsoft, Google, don't just come in and crush them. But as a pure volatility play on the shift to voice UI, it's certainly creative and definitely not financial advice.
That's why we call it the deep dive. We go where the reasonable analysts fear to tread.
Just please, listeners, do your own diligence. This is a small cap stock with a history of volatility. Don't bet the farm.
Absolutely. But hey, seeing a stock rip 47% in a single day, that's what keeps us coming back.
It definitely beats watching paint dry.
So to recap for the road, 8x8 delivered their third quarter of growth. They smashed profitability. Usage-based revenue is taking over the business model. And the Fuse headache is finally, officially gone.
And it leaves us with one big question to chew on. If seat counts are flat, but revenue is up, have we officially entered the post-SaaS era of software pricing? Is the monthly subscription dead?
That is a scary thought for a lot of Silicon Valley, but good news for 8x8.
That's it for this deep dive. Thanks for listening to Talk Tickers.
See you on the next stick.